Hello all, Tony here. US stock markets closed sharply lower on Friday, with Broadcom tumbling in the wake of Oracle's post-earnings sell-off, dragging the broader AI complex with it. The move accelerated a rotation out of tech names into cyclicals, and for the week, we saw the Dow Jones post its highest weekly close on record, gaining over 1%. In contrast, the tech-heavy Nasdaq fell almost 2% for the week. This stark contrast in performance across the major US equity indices is a classic example of intra-market divergence, which is where markets within the same asset class move in opposing directions at or near to new highs. Now, this intermarket divergences often appears at important turning points, and it tends to carry the most weight when confirmed by other technical signals or fundamental developments. Now, on the fundamental side of the equation, of course, we saw concerns around the AI trade reignite last week. Let's take a look at the charts of US equities to see where they are as we start this new week. Okay, so this week we're just going to quickly start with the Dow Jones. It doesn't usually appear in our videos, but for the point of this intermarket divergence, we want to take a look at what the Dow Jones has done. And as we mentioned, the rotation out of tech and into cyclicals and defensives sent the Dow Jones to fresh record highs above its November highs. Whereas with the Nasdaq, as you can see here, the November highs, or actually the October highs, were well defended last week, with the Nasdaq only getting as high as 25,835. And this divergence and this failure to break through the record highs last week does have us wondering whether the Nasdaq has in fact started a third leg of this three-wave correction to complete a wave four before pushing up to new highs. So that's probably at this point of time my base case, that while we're below this resistance coming in around 25,800 to 26,200-ish, we need to allow for another leg lower for the Nasdaq to complete a correction. So anywhere into this 23,500 area would be of interest from a buying perspective. Likewise, if it was to get above these record highs, then potentially we can start to look for a fifth wave up towards 27,000. But at this point in time, the jury is out on the Nasdaq. For the S&P, it's even more convoluted because the S&P has some of these defensive and cyclical stocks, and it also has tech stocks. And what you can see here is that while it wasn't able to break through this October high coming in at 69.20, it got as far as 69.03 last week. It hasn't really backed off like the Nasdaq has done. So I think what we need to do is be open-minded with the S&P 500 and the Dow. We are in a very strong seasonal time of the year now. And what we need to be mindful of is that while the S&P holds above a layer of support between 60, let's say 6,800 down to this 6760 area, then you would give the S&P the benefit of the doubt to allow it to push up to wave five to follow the Dow Jones. If, however, it breaks below 6760-ish, then it's probably more inclined to follow the Nasdaq lower. And then we're looking at potentially this wave four as being a three-wave correction, and it isn't complete. So this is wave A or one, wave two or wave B, and wave three or wave C. Brings us down here for a wave four before the push higher begins potentially in 2026, which takes us up to wave five. So I guess in summary, we do have some conflicting signals here. The Dow Jones ripped to new highs, S&P caught somewhere in the middle, and the Nasdaq definitely flagging. And whether the broader market follows the Nasdaq lower or the Dow Jones higher, we'll see further information, and we'll get more insights into that this week. That's all for now. Stay tuned for more market updates ahead.